Welcome to the California Small Business Tax and Money Podcast. My name is Megan Robin, and I am a California tax attorney with a Master's of Laws in Taxation. I help small business owners save money on taxes and get their finances on track. Today, let's talk about bonds. These are a huge topic right now. I'm recording this podcast in May of 2025, and there is so much market uncertainty right now and confusion about where to invest your money and what to do. So today, let's talk about bonds because a lot of investors, seeing all the uncertainty in the stock market, have been fleeing to bonds in hopes of finding a safe place to park their money. Let's start with what is a bond. A bond is an IOU. You are lending money to a government or to a company when you buy a bond. In return, you receive regular interest payments, usually about twice a year, and you get your principal back at maturity. Bonds fund things like government projects, like highways, or corporate initiatives. Are bonds a safe place to park your money? Well, let's take a look at how they've performed over the last 100 years and the different types of bonds that you can buy. Historically, bonds, like stocks, have experienced highs and lows. During the Great Depression, many bonds crashed, but U.S. Treasuries, which are bonds that you can buy to fund projects through the U.S. government, provided safety for a lot of investors. During the 1970s and 1980s, high inflation caused bond prices to fall. Bonds typically fall during periods of rising inflation for two main reasons. The first is the erosion of the purchasing power of the bond. So bonds pay fixed interest payments, which we already talked about. When inflation rises, the money you receive from these payments can buy you less than it did before. This means that its purchasing power is decreasing. For example, if your bond pays $400 every 6 months, but prices for goods and services are rising, that $400 you're receiving is not going to go as far as it used to. As a result, investors will demand higher yields, which is another way of saying higher payments, to compensate for this loss. This means that existing bonds that have been already issued and have lower rates are less attractive on the secondary market because no one wants to buy a bond that pays hardly anything, right? Central banks, like the Federal Reserve, often raise interest rates to combat inflation. I'm sure you've heard about this all over the news lately. When new bonds are issued at these higher rates, the older bonds that have lower fixed rates become less appealing. If you could get a bond today that pays 6% in interest over the life of the bond, why in the world would you bother with an older bond that you can buy on the secondary market that pays only, 3%? That makes the prices of these bonds, when people buy and sell them on a secondary market, those prices plummet because no one wants to buy those old low interest paying bonds. So this is what people are talking about when they talk about the effect of interest on bond prices. All right, continuing with our historical journey through time. After the 1980s, interest rates started trending downwards for the next couple of decades. You might remember this. This resulted in bonds doing super well. During the 2008 crisis, stocks plummeted, but treasuries went up because a lot of times when stocks plummet, people look for other places to store their money, like you're seeing right now. And a lot of people bought treasuries, which are government bonds. You may have heard a lot of financial advisors say that bonds can balance your portfolio because a lot of times when stocks fall, bonds are okay or vice versa. However, in 2022 and 2023, both stocks and bonds fell due to inflation and rate hikes. And this is a good reminder that bonds can be volatile too. It's not just stocks. Bonds have highs and lows, just like stocks do. So why do advisors recommend bonds, especially during retirement? Well, bonds are generally less volatile, so even though they can go down, they usually go down less. They often provide steady, regular interest income, which a lot of retirees want. And treasuries can be seen as a safe haven because they are backed by the U.S. government, which a lot of people believe will not fail and will never default on their payments. A very, very important distinction that you need to understand, and where I think a lot of people get confused, is there is a huge difference between individual bonds and bond funds. An individual bond is when you buy a bond directly. So from the U.S. Treasury, you can buy a bond directly on the Treasury Direct website, and you are transacting directly with the Treasury. You can also buy bonds directly from private companies. If you hold these to maturity, you get regular interest payments and you get your full principal payment back. This offers certainty and predictability if you hold it to maturity. So when I say full principal back, if you spent $100 on this bond, you are guaranteed to get $100 back at the end. And along the way, you will get interest payments throughout the term. A lot of people love this because assuming the company or treasury doesn't default, you have a guarantee that you will get at least what you invested back at the end of the process. The downsides can be, it can be hard to buy private company bonds. Some brokerages have fees or minimums when you're trying to buy a bond directly. The treasury, it's pretty easy. It's straightforward. You go to treasurydirect.com and you can get treasuries. But for private companies, it can be harder. And it can be harder to diversify among a lot of different companies, which is why some people flock toward bond funds. So a bond fund is when the fund manager pools all of the investor money together to buy a whole bunch of different bonds. There is no set maturity date, and you have no guarantee of getting your original investment back when you sell your shares. The value can fluctuate up and down, and the fund is constantly buying and selling different bonds. The pros of this is you're very diversified. If there's a ton of different kinds of bonds from different kinds of companies in this fund, then if a few companies end up not paying back the amount they borrowed, which is called defaulting, then you're hedged against that risk because there are a lot of other bonds within this portfolio. So one single company defaulting isn't going to take the whole thing down. The downside is you're exposed to market risk. So your bond ownership piece in this fund can lose value if interest rates rise, like we talked about before. So these bond funds are a lot more volatile and have a lot less of a guarantee than buying an individual bond. So there's a huge difference between buying an individual bond and buying into a bond fund. Bond funds act a lot more like the stock market does. There's highs, there's lows, there's buying and selling, and there's market risk. Many financial experts argue that this risk is a lot lower because bonds don't usually deviate and have as big highs and lows as the stock market does. As a tax attorney, I look at whether your portfolio makes sense from a tax and legal standpoint. For example, from a tax perspective, if I see unnecessary trading or dividend-producing stocks or income-producing bonds in non-retirement accounts, and that's triggering tax liability unnecessarily, I will flag this. A poor portfolio composition can also cause your business to be inadequately capitalized. A business is considered adequately capitalized when it has enough financial resources, such as cash, assets, or access to credit, to meet its foreseeable operational needs, pay its debts, and handle unexpected expenses or downturns. In plain language, if your business savings and investments are a mess and you could lose everything in a downturn, this is a problem. Next, for corporations, especially in the context of limited liability, there's a legal doctrine that requires companies to be adequately capitalized at their formation and during their operation. If a corporation is grossly undercapitalized, courts may allow creditors to pierce the corporate veil and hold owners personally liable for their business debts. So in short, you don't want your small business finances to be a mess. If they are, you're risking overpaying in taxes and could even be risking your limited liability protection, which is why you opened your LLC or corporation in the first place. That's all for today. I hope you got some great value out of today's episode. To set up a consultation with me, visit my website, meganrobin.com. This content is for informational purposes only and does not constitute legal, tax, financial, or investment advice.